Welcome to this Colorado Bar Association Continuing Legal Education Program.
I'm here with Ryan Arney of Davis, Graham & Stubbs, who is one of the moderators of the 4 panels at the Colorado Bar Association's Private Equity Conference on January 21. Ryan is really focused on one of what I consider to be the most interesting topics at the conference, which is what's the current state of investors, the LP market, the people who make private equity funds go. Ryan, can you give us a little bit of sense of what you've seen probably from the free fall days in the fall of 2008 to today?
Right, well thanks for having us, Nate. It's been an exciting time naturally for the limited partnerships, the private equity funds and hedge funds alike. There's a whole lot of money raised in 2007, maybe early 2008, and today, while many think that it's a tougher market for them, in fact, many of those funds sit on the hordes of cash today and are sitting there on the sideline waiting for valuations to right size or expectations to come back into balance between sellers and the funds. There are also, no doubt, the funds who have elected to raise a new fund, those that didn't get completed in their process before the downturn, continue to work in the market. And in fact, on our panel in January, we'll have a fund who actually changed their focus midstream because of demands from limited partners out in the market.
Luke Duster
at Capital Royalty, and it's telling, as they thought, like many of us thought, late 2008 into the spring of 2009, that distressed real estate and other commercial loans that were distressed might be a nice target, and it has been and will continue to be, but the limited partner market gave them feedback to go focus on something else. So as people go out and as funds go out and raise money, those that have had existing legacy funds who have succeeded and have had good IRR before are continuing to raise funds, and there will be a couple at the CLE in January who will be just in the middle of raising a fund, and I think fairly successfully. What the market has also told many of these sponsors, these promoters, is the fund size may have been reduced overall, and the fee structures may have shifted a bit.
Very good. Well, let's drill down a little bit into that area. Obviously, it's really, the balance of power, if you will, has shifted towards the LPs. LPs are making new and more stringent demands about returns, and if you don't achieve a certain threshold return, other substantive triggers kicking in. Talk to us a little bit about how that has changed over time.
Well, and specifically the old 2 and 20 model, I think, is still alive and well. There may be pressures from the limited partners to on that structure a bit. Now, whether that retreats to a 1 and 15 or the like, but I think the general structure has remained. Limited partners, the supply side into the funds, the limited partners and the pension funds and the endowments.
The supply of money.
Supply of money will. The supply of money is the endowments, the pension funds, and the like have had an imbalance during the last 24 months, where their alternative investments have become a greater portion of their overall portfolio, and as a result of that, they have been a little resistant to investing in new alternative investment categories, or restricted from investing in alternative investments. With the public markets bouncing back, that has brought their overall portfolio into balance, and many of them are prepared to make investments in the alternative investment community. The difference, however, is that while in 2006 and 2007 there may have been a scarcity of opportunity where funds or LPs were lining up to get into some of the leading funds, and some money moved from directly into the funds into funds of funds, as that may have been the only way for lesser tiered LPs to get into the primary funds. Now we're seeing that the supply and demand has shifted a bit, in that there isn't a scarcity any longer, and in fact the managers are knocking on the doors of the LPs, and therefore funds of funds, the demand for their space has fallen pretty dramatically in the last 12 months. And again, you're right, Nate, that the LPs can exert a little more force on the management teams of these funds. But with that said, they're still driven toward an overall return on investment for their pensioners and the like, and they still need a place to put money when the public markets aren't promising to return outsized IRR for them.
Well, what type of sponsors are succeeding in raising new funds, raising new capital, and which aren't?
As you would expect, the ones that have had a successful track record are certainly seeing success today. Those on the margin or with less IRR records are struggling a little bit today, and certain asset classes are seeing more interest today. For the longest time, for example, the private equity funds, some of whom who bought at the height in the hotel and hospitality space, generally speaking,
Real estate.
and real estate related, they shied away from that. And now, if you read in the New York Times here in early December 2010, there's a whole lot of money being devoted to that space now, as they believe that may have hit the bottom. So I think you're seeing a little more money going back into real estate. I think technology has been hot. Medical, the healthcare market has been pretty robust for the sponsors and the management teams raising money in those areas.
So technology, healthcare, a little bit of real estate focused on hospitality. We're standing as we speak in downtown Denver, Colorado. Is there any difference in the LP market here versus nationwide?
You know, I can't tell you that there is. I know that the two of the primary funds here in Colorado, in Denver, one closed a fund in late 2007, so they beat the clock, and then another fund locally who will be represented at the CLE in January are in the middle of their fundraising process. So we'll see. And again, I think both of those groups had great
What sector focus?
records. Well, the latter of which is, who I can speak to more, has a healthcare focus, food specialty focus, and an industrials focus, I believe.
So medical technology and manufacturing?
Right.
Very good. Is there anything else that you can tell us about where you see the LP market going in 2011? Is the balance of power going to shift again between the funds and the investors, or are we going to continue to see investors, being in the catbird seat?
Well, I think two things. I think one, we'll see how successful the management teams are in deploying the capital that they have, because again, from all of the reports and statistics that we can review today, it appears there is a large amount of capital sitting on the sidelines. So depending on where that money goes, and also where the public equity markets go, with bonds have been the flavor of the last few months. Private or public equity markets have rebounded somewhat, mixed signals about where they may go, but naturally the private equity and venture capital and hedge fund spaces for the LPs need to trade at returns that far outstrip what their public equities could do because of liquidity and the like that we all know about. So if public equity returns increase, then the demand from the limited partners is that they need their private equity portfolio to have an outsized return, and the mix and the battle there will be an interesting one. To your question, if the public markets were to be flat, then it's easier for the management team to get a little more leverage to say, if you're making 2% in the public markets and I can get you 12%, bring your money to me. And if that were the case, we all hope that's not going to be the case, but if it were, then I would think we'd see the management teams have a little more power in sort of that supply and demand.
Might the LP market be suffering the same sort of psychological malady that maybe the consumer market is, a lack of confidence, a lack of certainty, a lack of optimism? LPs want to see, obviously, the public markets do better than 2%, maybe 5%, and if it's doing 2%, that might not necessarily shift balance of power back to the funds, but continue to feed this miasma that's throughout the LP market and making them resistant to investing.
I think that's a good question, Nate, and that's likely the case. The folks who sit with their endowments and their pensions and the stewards of the big chunks of money, they have to be viewing this just like we do, that when they give a chunk of money or a commitment to these management teams, when you actually fold that into the portfolio companies, at what valuation and what are the projections that those portfolio companies that they're really investing in, what are they providing? Are they real? have they been right-sized to the projections that we all believe? Is it tailored to the savings rate and the expected consumer spend and the like? And again, outside the notable healthcare and medical technology spaces, there is a great deal of uncertainty, and I think they will see. We'll see them to be sensitive and some elasticity there with the LP's decisions, but at the same time, when they're managing an overall portfolio, again, it will be largely contingent on what the returns they can expect in their other asset classes.
Perfect. Ryan, Arney, again, Davis, Graham, and Stubbs, thank you for joining us this afternoon and at the Colorado Bar Association's Private Equity Conference on January 21. Thank you.
Thank you.